A brief intro. There are people here who are meeting me for the first time, so I thought I'll just spend a minute on that. So I'm Prabha Srinivasan. I'm a founder, CEO of Ventura Pranas. It is a cross-border advisory and compliance firm specializing in US and India tax and compliance and advisory. And we are a 100-member team, and we're located between Chennai, Los Angeles, Trichy, and Bangalore. I'm dual certified, and that was the genesis of the firm, and we've grown since our formation in 2011. This slide only covers TDS. It does not cover bank accounts. It's a misnomer. So let's discuss it. So TDS, or tax deducted at source, is nothing but withholdings, as we call it in the US. And it is a factor of residency, the question of who the seller is. Is he a resident of India or is he a non-resident of India? It's also a factor of the sale consideration. Now, if somebody is a resident of India and the sale consideration is less than 50 lakhs, the person buying the property is under no obligation to withhold taxes. If it exceeds 50 lakhs, his only obligation is to take out a percentage point on the sale consideration. Okay, so keep in mind it's on the sale consideration, it's not on the capital gains. But it's still not such a bad outcome because you're only looking at a percentage point. But switch gears and look at a non-resident. Okay, so I think this is a ploy by the tax guys to say we don't want any tax to escape the tax net because we're dealing with people who are not resident in India, may not have filed returns in the last 2 years, and therefore how do I keep my teeth in them? The only way to do it is to make sure that they take as much tax as they can, and they do it on the sale proceeds, and that too at the maximum marginal rate of 23.92. So what is the downside of this? The downside is, number one, your capital gains could be much smaller. And as we take you through some of the examples as we go forward, you will see that the cap gains can shrink dramatically in certain circumstances. You're looking at a huge tax refund, and everybody knows how much of a challenge it is to get anything out of the Indian authorities. Worse yet, if you have an outstanding issue from a prior year, it might even be a 10 rupee due that you overlooked. They'll say you've got outstanding dues from the past, we can't clear this until you've sorted that out. So, and it could necessitate going and pleading with an officer, and you know where that leads us to. So, so that's something to keep in mind. And so is there relief from this punitive withholding? The answer is yes. There's something called a Form 13 application that you can make to the income tax authorities. It's to the IT officer, but you can't do it on a hypothetical deal. So don't assume that, okay, I'm going to sell in 2 years, let me keep it ready. You have to have a transaction that's well in flight, which means you should have an agreement to sell. You should have a draft of the eventual sale and purchase agreement. You should have other documents in line, including copies of the prior 2-year tax returns. The buyer must have a TAN number. You've got to have the cap gains computed, which means you have to have proof to support the purchase price, the date it was handed over, because your completion date dictates your hold period, and any improvements that you're claiming as cost reductions and offsets against the sale price have to be clearly documented. So it's a lot of paperwork, but I think it's worth the pain. You've got to give yourself time. Do not show up in India and say, I'm going to close the deal in a week, I need this done. You probably have to work towards it. If you have a buyer waiting in the wings, please start the process well before you plan. Let's get into the more complex bit, which is how is basis. So there are basis generally means cost, okay, and how do you acquire an asset? It's usually purchased, or it is gifted to you, or you inherit it, right? These are possibly the three only ways you get it. I mean, it's very rare that it just falls on your lap. So my point is, these are the three ways you get it. And India makes one more distinction. They actually want to know when the asset was originally purchased. Was it a pre-2001 purchase, or was it an after 2001 purchase? And why is that important? Well, India gives you the ability to inflate your cost for inflation, so you're adjusting your cost upwards. Why is it helpful? Because it reduces the effective capital gains because your offsets against the sale proceeds goes up. So by way of a simple example, we've just told you that a baseline year they use is April 2001, and they've issued a CII index of 100, which is your baseline. And so let's assume you're going to sell this in 22. In this example, I've actually said the property sells in 23, 24, where the CII is 348. So roughly 3.5 times, right? So you take your cost basis or the guideline value on April 1, 2001, apply the 100, divide by 100 and multiply by the 350. So you actually arrive at a cost which is almost 3.5 times that number. Now, let's look at the other scenario. The purchase of the asset was post-2001, except instead of using a 100 factor for the base year with the year of acquisition, you use that particular year's CII index. In this case, I've looked at an example of a 2008-9 acquisition where the factor is 148, and 22-23's disposal, I've just taken that example, is 300, so roughly doubling the cost basis. So it does help. The good news from an India side is that they make no distinction between an inheritance or a gift. It's the same, does not matter how, you learn it once and you've learned it, okay? So that's a little bit about basis computation on the India side. Let's talk a little bit about the US. Now, the US does make a distinction. The first thing you should know is that US does not allow you to adjust basis for inflation, okay? So, but what does help us is that the relative decline of the Indian rupee versus the dollar, or relative to the dollar, does come in to help us. And to give you an example, if you purchased the asset, say in 2001, and it was a 3 crore property, and the exchange rate then was like 46 to 47 rupees, you divide by that, and so your cost basis is around 640,000. You're not dividing by 78, which is today's exchange rate, right? It'll dramatically change that number for you. So you do get that benefit. Your cost somewhat gets adjusted, thankfully, because the Indian rupee has declined and it has helped us get in that little bit of delta. Inheritance, I think this is like the really powerful aspect of US laws, is that if you acquire an asset by way of inheritance, your cost basis becomes readjusted to the fair market value on the date of death of the decedent. And it is something several of our clients have benefited from, okay? So what happens is, let's say the person who you're inheriting it from dies in 2017, the fair market value on the date of death was 5 crores. I use the exchange rate then, which is 67 to 68, and I come up with a cost basis of about 737. Push it out for a few more years. Let's say this person died in 22. You're looking at a 5 crore property, but the exchange rate whittles it down to like 636K, right? So I'm hopeful this is just, enough for you to understand as we go into the next math, the demonstration of how all of this works. Gift, again, they make no distinction from the purchase. The original purchase, the value to the purchaser or the donor, as well as the holding period of the donor, passes on to the donee. You use the same mechanics. If for some reason the donor also inherited it, then you can apply these inheritance rules, right? And step it up to the basis or the fair market value on the day that the donor got it. So similar principles, but I think it's important to discuss with you how the basis computational differences work. Now let's go into a simple example. We've kind of kept out vagaries like depreciation. We don't want to confuse people. If there are questions around it, you can certainly reach out to us. But here is a simple example. We're talking about an asset sale, the sale price of which is about 5 crores. We've talked about the purchase to be a 2012 purchase. I have a CII index of 200. We've kept it easy. That's the CII for that year, 10 years or 12 years out. 2022 is the date of sale, and we're looking at a multiplier of about 3.31. So, and then the purchase price, we're looking at a 56 lakh purchase price. Improvements, I'm assuming, was about 1 crore. And then expenses of sale, all in, we just assumed a 7% of gross proceeds. And I've given you some exchange rates there on the date of purchase, date of sale, just to show you how that's kind of swung, right? You're looking at 50 to 78, 52 to 78. And then residential status, this person decided also to move to the most expensive state in the US, which is California, and we're dealing with a non-resident Indian, okay? And then the fair market value, we've also added one scenario there saying, what if this person got it by way of an inheritance, just to tell you how that changes the math on the US side. So, the source information is on the first column, as you can see, that's shaded in gray. And then the second column computes the purchase, gift, inheritance situation in India. It's very simple. We have the sale price of 5 crores. You can see that the index cost jumps. It's gone from 56 lakhs to 93 lakhs. And likewise, the improvements have jumped from 1 crore to 1.65 crores because of the power of indexation, right? And then you've got commission expenses of about 35 lakhs. You've got a total net cap gains of about 2 crores. It translates to about 49 lakhs of taxes. That's approximately $63,000 in USD, okay? So I'm just putting that out there so that you see what happens. So this is the Indian capital gains, assuming you do nothing fancy in terms of reinvestment. I'm going to put up the next situation, which is what happens in the US. Simple again, you take the sale price, you convert it on the date of sale, you take your cost and improvements, again, exchange rate on the date on which each of these occurred. I've got my commission costs, and then I've got total capital gains of roughly $300,000, applying the rate in the US, which is the 20%, okay? We're not dealing with net investment income tax yet. This is to demonstrate to you how it works. You can see there's a 59K US tax bill. So here's the relief. You're looking at India taxes being roughly 63,000 here. And of that, some part of it is going to go on to offset the 58,702. Okay, so you get a complete write-off of the US taxes, and then comes the killer, right? The net investment income tax is 3.8%, and it's on the amount of cap gains, and so that translates to the $11,000. So you're stuck with paying the 11K to the feds. There's no getting away from it. There is no excuse for it, except if you're an active real estate professional. Please talk to us and we'll tell you under what circumstances this could also go away. But it's very rare that if you're just a standalone full-time employee somewhere else and you're selling a standalone property, you can't qualify for it, okay? And then we move on to, as if that weren't bad enough, we also have to deal with California now, and applying the 13.3%, we're looking at a 40,000 California bill. So right there you got it. India is 63, US is 11, California is 40. That's your tax bill worldwide, okay? Now take the last column, which is inherited property in the US, right? What happens in the US? I told you the value or the cost basis gets stepped up to the fair market value on the date of death, which was about 4.9 crores. So look at the offset. The sale price is the same, but your offset is dramatically different. And I end up with a loss after my commissions. So I have nothing to pay to the US, okay? So it's only the Indian tax bill, and that is your worldwide bill, okay? So this is to demonstrate to you how, by way of a very simple example, how the math works.